Picture the scene. It's 11:30 a.m. on a Tuesday. You're at your desk trying to get some work done, but you glance at your phone
The
and you see a notification.
Oh, no. I know exactly where this is going.
Yeah, you see that a specific stock ticker is up 18% since the market opened. So you tap it. It is just a vertical green line. You switch over to X or Reddit or whatever platform you use, and it is absolute bedlam.
Just wall-to-wall rocket emojis.
Exactly. Rocket emojis everywhere. Screenshots of people making, 500% gains in an hour. People screaming strong buy. Analysts are upgrading their price targets in real time.
Yep.
Even your college roommate, the guy who thinks a 401k is a type of distance run, texts you asking, "Are you seeing this?
Yeah.
Are we getting in?"
The siren song of the parabolic chart. It's so visceral, isn't it?
It is physical. You get that tightness in your chest. It's panic. You feel like a train is leaving the station, the doors are closing, and you are literally the only person left standing on the platform.
Right.
Your thumb is hovering over the buy button on your brokerage app, not because you know anything about the company's cash flow, but just because the pain of missing out is actually physically hurting you.
And that pain is real. I mean, evolutionarily speaking, being left behind by the herd meant death. If the tribe ran, you ran. You didn't stop to ask why, you just ran to avoid whatever predator was coming.
Yeah, survival instincts.
Exactly. But in financial markets, that biological imperative, that herd mentality, is probably the single most destructive force to your net worth. It's a survival mechanism that has completely morphed into a financial liability.
And that actually brings us to our specific mission for today's deep dive. We received a fantastic question from a listener, a beginner investor, who described this exact scenario, feeling like a leaf blowing in the wind of market noise. And they asked a simple but profound question. How do I actually learn to think independently when the noise is this loud?
It's the million-dollar question, isn't it? Because most of the advice you get is just useless platitudes like, do your own research.
Which means nothing.
Right. Nobody tells you how to do research that isn't just confirmation bias in disguise. If you Google a stock, you already you're just hunting for reasons to agree with yourself.
Exactly. So to answer this listener's question, we've done a deep dive into a really fascinating practical guide. It's called the Contrarian Investor's Handbook, 7 Drills to Defy the Herd. And what struck me immediately about this source is the format. This is not some dry finance textbook full of discounted cash flow equations.
No, not at all.
It actually reads more like a strength and conditioning manual for an athlete.
That is the perfect analogy. It treats independent thinking not as this innate talent you're just born with, like having blue eyes or something, but as a muscle.
A muscle that is currently atrophied.
Highly atrophied in most of us, yeah, because we outsource so much of our thinking to the internet. So this handbook is all about tearing that muscle down and rebuilding it through very specific, repetitive drills.
And we're going to walk you through the most critical drills from this handbook today. We'll cover how to structure your information diet, how to sort of datafy your emotions, and how to build a portfolio that might look a little lonely but performs better. But we really have to start with the heavy lifter. The source calls it the solo thesis first exercise.
This is the foundation. Really, if you turn this deep dive off after 5 minutes, which please don't, but if you did, this is the one concept you absolutely need to take with you. It changes everything about how you interact with financial information.
So let's unpack it. The core philosophy here is really about sequencing. It's about when you let outside information into your brain.
Precisely. The rule is simple, but it is excruciatingly difficult in practice. You must force yourself to form a judgment before you allow the crowd to tell you what they think. It's all about avoiding anchoring.
Anchoring. Let's define that for a second.
Sure, it's a cognitive bias. The first piece of information you hear about a topic essentially becomes the anchor against which your brain measures everything else. So if you open Twitter and read a headline that says, company X is the next Amazon, your brain anchors to that.
And then you're stuck there.
Yeah, even if you try to be really critical later, you're mostly just arguing against that anchor. The solo thesis drill is designed to prevent that anchor from setting in the first place.
Okay, let's walk through the practical steps of this, using a real-world example, because our beginner listener wants to know exactly how to execute this. The source mentions hot topics like AI infrastructure or those new GLP-1 weight loss drugs. Let's stick with a hypothetical massive AI chip manufacturer. Everyone is talking about it. Step 1 is pick the target.
Right. You just identify the thing making the noise. Let's call our hypothetical company Tech Corp. Step 1 is simply admission. I am interested in Tech Corp.
Easy enough. But step 2 is where the discipline really kicks in. The source calls it the pre-mortem or the private phase. And it is incredibly strict here. You cannot open Google News. You cannot check the stock price history. You cannot read a bank analyst report. You have to sit down with a blank sheet of paper.
This is the clean room approach. You have to write a one-page assessment based only on primary sources. We're talking the company's 10K filing, their official website, or just your own raw logic. You are forbidden from ingesting opinions. You are basically isolating yourself from the virus of the crowd.
And we aren't just doodling on this paper. The handbook requires 3 very specific components on this page. What are they?
First is just basic financial literacy. What does this business actually do? You would be horrified by how many people own stocks without being able to explain the business model to a 10-year-old.
Saying they do computer stuff definitely doesn't count.
Exactly. You can't just write tech. You need to write something like, they design GPUs for data centers, and they license software to enterprise clients. If you can't write a sentence like that, you have no business buying the stock.
Period.
Yeah.
Okay, so what's component 2?
Why might this be undervalued or overvalued? You have to generate the bull and the bear case yourself using your own brain. And then the third component, what are the key drivers, the specific risks, and give it a rough valuation and a time horizon.
So let's play this out. I'm the beginner investor. I'm looking at this hot AI stock, TechCorp. I sit down, my phone is turned off. I write, okay, they make chips. Demand is crazy high because everyone is building AI models. But maybe they are overvalued right now because everyone already knows this. Risks. Well, maybe big tech companies start making their own chips instead of buying from TechCorp. Time horizon, 5 years.
That right there is your solo thesis. Now, it might be messy. It might even be technically wrong. You might miss a huge piece of the macroeconomic puzzle. But it is yours.
It's pure.
Exactly. It's uncorrupted data. You have established a baseline that isn't dependent on what some stranger on the internet thinks.
Okay, so I've got my messy one-pager. Step 3 is entering the noise.
Yes. Now, and only now, do you open the floodgates, go read the Wall Street Journal, go read the glossy analyst reports from Goldman Sachs, go see what the influencers on X are screaming about, let it all in.
And this leads us to step 4, which the source presents as the real aha moment of the drill, the comparison.
This is where the actual learning happens. You take your messy private note and you lay it side by side with the polished market commentary you just read, and you ask yourself one specific, highly critical question.
Which is?
Where did my view change purely because everyone thinks X?
Wow, that is a really powerful diagnostic tool.
It forces you to see the gap. Let's say in your private note you thought TechCorp was risky because of that competition risk you mentioned. But then you read 5 articles from experts saying they have an insurmountable moat. The competition is years away.
And suddenly my risk assessment feels silly, and I feel much safer about buying in.
Right, but you have to catch yourself in that exact moment. Did you actually find new, concrete data? Did you see a patent filing that mathematically proves they have a moat? Or did you just succumb to the social pressure of 5 smart-sounding people aggressively agreeing with each other?
It's about spotting that drift in your own mind.
Exactly. The source actually recommends doing this exercise weekly. It trains you to start with private reasoning. If you do this every single time, eventually your brain stops looking for the crowd's approval and starts hungering for raw facts. You become immune to the hype cycle because you've already done the foundational work. You aren't looking for a savior to tell you what to do. You're just looking for missing variables.
It's kind of like putting on really strong noise-canceling headphones before you try to write a song.
Yeah.
So you don't just accidentally rewrite whatever the top pop song is on the radio.
That's a great analogy, yes. You force yourself to create the original melody first, and only then do you listen to what others are doing.
So that covers the logic side of things. That helps us protect our cognitive processing power. But we are biological machines. We have feelings. And the source material shifts gears here to talk about the emotional side of investing, specifically FOMO, the fear of missing out.
Because logic is great, but emotions are so much faster. Daniel Kahneman, the Nobel Prize winner, he talks about System 1 and System 2 thinking. System 1 is fast, emotional, instinctive. That's the run from the bear survival system we talked about earlier.
And System 2 is the slow one.
Right. System 2 is slow, deliberate, and logical. When the market is crashing or conversely skyrocketing, System 1 totally hijacks the controls. You can have the best, most well-reasoned solo thesis in the world, but if System 1 takes over, you just panic and mash the buy or sell button.
Which brings us to drill 2 from the handbook, mastering the emotions via FOMO journaling. Now, I have to say, journaling sounds a little bit soft for a hard-hitting finance deep dive. Is this basically a therapy session?
It sounds a bit new age, sure, but it's actually a rigorous data collection exercise. The whole goal is to take these nebulous herd emotions and turn them into explicit, hard data points that you can analyze objectively later.
Okay, so how does the drill actually work?
The protocol is strictly defined. For one full month, every single time you feel that panic, that urgent burning impulse to buy because the line is going up, or sell because it's crashing, you have to open a log.
And what exactly are we logging in there?
3 data points. 1, the trigger. What specifically caused this feeling? Was it a tweet, a friend boasting at a barbecue, a really scary headline about a looming recession? 2, the impulse. Write down exactly what you want to do. I want to liquidate my entire portfolio right now. And 3, the herd perception. What does everyone else currently seem to be doing?
Okay, so I write down, trigger saw a tweet about a coming recession. Impulse panic level 9 out of 10, want to sell everything to cash. Her perception, everyone else seems to be selling in a panic. I log that. Then what?
Then comes the cooling off period. This is the hardest part. The strict rule in this drill is that you must wait 24 full hours before acting on any impulse you just logged.
A 24-hour mandatory pause. That alone seems like it would save a lot of portfolios from disaster.
It absolutely does. It essentially bridges the gap between System 1 and System 2. It gives the adrenaline time to fade so that logic can actually re-enter the room. But the real magic of this drill happens in the review phase. The source says after 1 or 2 months of doing this, you have to go back and read your entries.
And what are we looking for when we read them?
Pattern recognition. You'll look back at a panic moment from, say, 4 weeks ago, and you'll see that if you had actually followed the herd and sold when you wanted to, you would have locked in a massive loss right at the absolute bottom of the market. Or if you had bought that hot AI stock on impulse, you'd be down 20% today.
Wow.
When you see in your own handwriting exactly how often your gut feeling was dead wrong, it breaks the spell.
You're basically building a comprehensive dossier on your own bad habits. You're proving to yourself with your own data that your so-called intuition is often just indigestion.
Or just imitation. You realize pretty quickly that you aren't a misunderstood market genius. You're just a social primate trying to fit in with the group. And honestly, that realization is strangely liberating. It gives you permission to deeply mistrust your initial reactions.
That makes a lot of sense. Okay, so we have the solo thesis to guard our logic. We have the FOMO journal to manage our emotion. Now let's talk about structural guardrails.
Yeah.
Drill 3 is about structural defenses. This is where we get into checklists and information diets.
Right, because willpower is a highly finite resource. You can't just try really hard not to be biased every single day. You need physical guardrails that work even when you're tired or stressed or hungry.
The source suggests a herd checklist that you literally have to fill out before executing any trade. There are a few really punchy questions here, but one in particular stood out to me. If nobody else were talking about this, would I still buy it?
That question acts as a brilliant filter for what we call social utility. Very often, we buy popular stocks not for the expected financial returns, but for the conversation. We want to be part of the NVIDIA club or the Tesla club. It feels good to belong to the winning team.
It's status.
Exactly. But if you mentally strip away the social aspect, does the asset actually stand up on its own fundamental merit?
Another key question on this checklist is, how did this idea come to me? Did it come from a cold, objective data screen you ran? Or did it come from hype and word of mouth?
And perhaps the most important question on the list, who is on the other side of this trade and why might they be right? You have to remember, the stock market is a two-way exchange. For every single share you buy, someone else out there has decided to sell it to you at that exact price. Are they just stupid?
Probably not.
Probably not. Maybe they know something you don't. If you cannot clearly articulate why the other person is selling, you probably shouldn't be buying.
Now, running alongside the checklist, the source prescribes an information diet sprint. And I have to say, this sounds incredibly painful for news junkies.
It is a full detox. The source suggests doing this for 7 to 14 days straight. You completely eliminate all intraday checking of stock prices, no watching financial TV networks, no scrolling finance, Twitter, or Reddit during trading hours.
Going completely cold turkey on the market.
Not completely, but close. You are allowed one info block. This is a single scheduled 30 to 45-minute window per day, usually after the market closes, where you can review your data and read the news.
Why is this so effective? Is it just a time management hack?
No, it's about breaking information cascades and drastically improving your signal-to-noise ratio. Behavioral studies show that herding behavior is much, much stronger when you are constantly bombarded by short, highly noisy signals.
Like ticking red and green numbers.
Exactly. Ticking numbers and 280-character hot takes. That is all noise. Real, actionable financial trends happen over quarters and years, not over minutes.
So by checking prices every 10 minutes on your phone, you aren't actually getting more information, you're just getting more anxiety.
Precisely. You are overdosing on noise. When you deliberately slow the flow of information down to just once a day, the true signal finally clarifies. You stop reacting to the intraday chop and you start seeing the longer-term trend. You make your trade decisions outside that info block using your written checklist, not in a panicked reaction to a flashing red light on a screen. You essentially regain control of your own attention span.
Let's move on to drill 4. This one is all about intellectual rigor. The source calls this the devil's advocate review.
This drill is directly inspired by Charlie Munger, the legendary investor. He famously said that he never allowed himself to hold an opinion on anything unless he could state the opposing argument better than his opponents could.
That's a high standard. The drill uses a technique called inversion. Walk us through how we actually do it.
You take a really popular trade. Let's go back to our earlier example where everyone is long mega-cap tech stocks. Step 1 is to write out the consensus bull case. Write down exactly why everyone thinks it's a sure thing. Growth is infinite, margins are incredibly high, they basically own the future.
Got it. And step 2.
You invert it. You assume the crowd is dead wrong. Your job now is to build the strongest 3 to 5 bear arguments you possibly can. You become the prosecuting attorney against the stock. And you can't just be lazy or sarcastic about it. You have to genuinely hunt down the data that hurts your feelings. You have to find the real cracks in the armor.
And step 3 is the falsification phase.
Yes. You ask yourself, what specific evidence would falsify the consensus? Like, what real-world event would have to happen for this incredibly popular trade to turn into a total disaster?
So instead of just looking for more reasons to agree with yourself, which feels really comfortable, you are actively hunting for the evidence that would blow your entire theory up.
It trains your brain to value objective truth over social comfort. It's essentially about killing your own darlings before the market does it for you.
The source also mentions something called rule-based anti-herd rebalancing in this section. This seems a lot more mechanical than the intellectual exercises we've been talking about.
It is entirely mechanical, and that is exactly why it works so well. It removes the real-time decision-making completely. You define a target allocation for your portfolio. Say you want 60% of stocks, 30% in bonds, and 10% in cash. And then you set a strict rule. If any of those categories drifts by 5%, I rebalance immediately, no matter what the news is saying.
So if stocks go on a massive bull run and everyone is totally euphoric, my portfolio might drift up to 70% stocks. The rule says I have to sell.
You have to sell. You must sell the asset that everyone currently loves because the price is up, and you use that money to buy the asset that everyone hates because the price is down. It forces you to actually do the thing everyone says they do, buy low and sell high.
But doing it automatically.
Right, and let me tell you, it is incredibly painful in the moment. It feels completely counterintuitive. It feels like you are cutting your beautiful winners just to water your weeds, but historically speaking, it is one of the very few reliable, systematic ways to beat the herd at the extremes of market cycles.
Okay, we are coming up to the final drill, drill 5. And I think this is absolutely perfect for our beginner listener who might be listening to all of this and thinking, okay, this all sounds great in theory, but I am terrified to actually bet against the market with my life savings.
And that is a very valid fear. Being a contrarian is inherently risky. If the herd is actually right about a trend and you are wrong, you lose real money. And as the old saying goes, markets can remain irrational far longer than you can remain solvent. That is exactly why the source suggests starting with the paper-contrary portfolio.
This is basically a simulation, right?
Yes, exactly. You maintain a small, paper-only portfolio, meaning you are just tracking it on a spreadsheet using no real money.
And what goes into this paper portfolio?
2 specific types of assets. First, you put in names that the crowd absolutely loves right now, but that your solo thesis tells you are wildly overvalued. You effectively short them on paper. And second, you put in names that are deeply hated, completely ignored, or distressed, but that you think are quietly undervalued.
So you're basically building a portfolio of ugly ducklings and betting against the swans.
Yes. And you track its progress monthly. But, and this is the absolute key to the drill, the goal is not just to see if you make paper money and get to be right.
Then what's the point?
The point is to build emotional familiarity.
Tell me more about what that means.
You need to know in your bones what it actually feels like to be early, to be lonely in a trade, to be visibly wrong for a sustained period of time. When you track this paper portfolio, you will almost always see that the hated stocks stay hated for months and months before they finally turn around and the market recognizes their value. You get to observe the lag firsthand.
It's almost like a flight simulator for contrarian investing. You can crash the plane a few times on the simulator so you learn how the controls feel, ensuring you don't crash it when you're flying in real life.
Exactly. It completely desensitizes you to the intense social pressure. You realize, oh, I was actually right about the fundamentals of that distressed asset all along. It just took 6 brutal months for the narrative to play out. So the next time, when you are deploying real capital, you already have the stomach to wait out those 6 months without panicking. You've built up the psychological scar tissue in a totally safe environment.
That is incredibly practical. So let's bring this all together. We started with a clear mission today, helping our beginner listeners stop blindly following the herd.
And we gave them a concrete toolkit to do exactly that. We had the solothesis first exercise to fiercely guard your logic, forcing judgment first, and crowd data second. We have FOMO journaling to guard your emotions, treating your own panic as an objective data set to study.
We have structural defenses, utilizing the pre-trade checklists, and forcing information diet sprints to cut the noise. And finally, the intellectual rigor of the devil's advocate review and the paper portfolio to safely practice the very difficult art of disagreement.
It really is a comprehensive operating system for your mind. And if you zoom out and connect this to the bigger picture, avoiding the herd isn't just about being difficult for the sake of it. It's not about automatically disagreeing with people just to look edgy or play the contrarian hipster.
Right, because sometimes the crowd is right. If everyone is running out of a burning building, you should probably run out too.
Absolutely. But you need to know exactly why you're agreeing with them. It is all about intentionality. Knowledge is most valuable when it is rigorously applied through your own critical lens, not when it's just passively absorbed through osmosis from market chatter. You want to be the person who runs out of the building because you actively assessed the situation and saw the fire, not just because you saw other people running.
So for our listener who originally asked the question, you really don't have to be a mathematical genius or a Wall Street insider to beat the herd mentality. You just have to be more disciplined than the person next to you. You have to put in the reps, you have to do the drills.
Correct. Independence of thought is a practice, not a personality trait. It's something you actively do every day, not just something you inherently are.
Before we sign off on this deep dive, is there a final thought or maybe a challenge you want to leave our listeners with, something for them to chew on?
Yeah, I'd leave you with a thought that is derived from that checklist section we discussed, but expanded a bit. Next time you feel an intense, urgent need to make a financial move, whether it's to buy, sell, rotate, whatever, just stop, take a breath, and ask yourself this. If I were the only person on Earth looking at this raw data, if there was no Twitter, no CNBC flashing alerts, no friends to brag to about my gains, would I still make this exact same decision?
If you were the only person on Earth, wow, that is an incredibly high bar.
It is. But it strips everything away. It brutally reveals exactly how much of your conviction is real and how much is actually just disguised social pressure. It shines a very bright light on the invisible strings the herd is currently using to pull you along.
I love that. Okay, everyone, your homework is clear. Next time you spot a stock skyrocketing with rocket emojis all over your feed, try the solo thesis. Write that pre-mortem out before you click on a single news article. See what happens to your thought process. Thanks for diving in with us today.
Happy investing. Keep doing the drills and stay independent.